We'll take the roll.
Okay, Chair,
Here.
Controller's Office,
Yeah.
Public Advocate's Office,
Here.
Borough President Manhattan,
Here.
Borough President Brooklyn, Borough President Queens,
Here.
Borough President Staten Island,
President.
Borough President Bronx, International Brotherhood of Teamsters, here, Transport Workers Union,
Morning, President.
District Council 37. We have a quorum.
Great. In no minutes, so we go right to number one.
Yeah, goes right to left.
Larry, August monthly performance review.
Thank you. Everybody have their monthly package? Martin has extras if you need them. You should have them in color. You did say red. No, the reason I say is the red or bad. Yeah, I know. It's good. Yeah, I took it back to the ranch after the last one, didn't get anywhere. Ready?
Ready.
All right, we'll do this pretty fast because it's pretty straightforward. So this is the month of August. Everybody was on vacation. The markets kind of drifted upward. September was good. October's a little more choppy, just to glance ahead. And the good things that happened to the markets actually all happened in September. So maybe I'll just hold on with what's going on in the markets until September review, because then you can see the numbers. But they generally drifted upward, perhaps in anticipation of good things coming. So if you flip to page 32, you can see the monthly progression at NYCERS. We ended at about 42.4 billion, which is, I think, the highest ever. And you recall that NYCERS is cash flow negative, so that's a good thing. And if you look on the next page, 33, again, we've dug ourselves out of the hole from 08-09. The reason that things went well is if you go to page 40, in the far left-hand column, you can see the equity markets in the U.S. They were all up about 3%. The next block of numbers, EFA was up 2.5%, emerging markets was sort of flat, and the bond markets were all up a little bit. So that leads to good things. In fact, if you go to the next page, page 41, you see it was sort of that plus something as a glimpse into September. So again, the July numbers were good, the August numbers are good, the September numbers are also going to be good. And again, if you then flip forward into page 42, the far column on the left is the 1 month of August. We made about 1.6%. And if you look at the third column, you add that to the 1% or so that we made in July, so we're about 2.5% fiscal year to date. And we probably made another 1.5% in September, so I'd say we're about 4% year to date, October being a little choppier. If you go back to page 36, look at our mix of assets. We're pretty much in line with the bands. Since this date, just to bring you forward, we funded some of the bank, about 0.5% in bank loans, pursuant to an RFP that we completed. We did some rebalancing at tips, so we got ourselves back into the range. It's the purple, about 7 from the left. So we're basically in the range of on all the asset classes. We funded those two things out of a combination of selling down a little bit our overweight in U.S. equities and taking the cash down. Again, since end of August, between the transactions I just described as well as paying benefits, we have about zero cash, plus or minus a little. So it is what it is, and again, we're inside all the ranges. So we're inside the ranges for all the asset allocation. We're making money. I expect the rest of the year to be a little more difficult in July, August, and September because of choppiness brought on by the U.S. election, the fiscal cliff, stuff in Washington, stuff in the Middle East, concerns about the economy. I just think it's going to be profit-taking for people who live on a calendar year basis. So I just think it'll be hard for us to keep these gains throughout the rest of the year, but we'll see. Again, all eyes are really now in the United States, with the ECB having said that they're all in, and the Fed saying, QE3, it's kind of all in. So that's kind of where we are. We're at about $45 billion in aggregate, up from 44 and change. Seema, you have any comments on equities?
No.
Martin? No. Barry?
Nope.
Kara? No. Okay. Any questions of anybody on August? August was pretty straightforward.
One quick question, Larry. Previous board meetings, you've agreed to whatever the portfolio's been outside its policy range. You've agreed to give us just a summary report as to what the deviation was, quick rationale on it, and basically a postmortem after the fact. Can you just bring that report that you're preparing for other boards to this board's attention going forward? This is the compliance report, I believe, is what Janice has referred to it as.
Yeah, we could talk about that offline, because I'm still not sure what report you're referring to.
Okay.
So I don't want to promise something I don't know what I'm promising.
Okay, happy to.
Any other questions? Okay. So August was good, September's going to be good. Stay tuned for October. That gets us to infrastructure. We've talked before about entering infrastructure. Today is an educational session for the trustees. We have Petya and Evan, our infrastructure team, assisted by Townsend. Townsend, as we all know, is our real estate consultant. Townsend also does infrastructure. They've agreed to help us with some education, and at some point we're going to decide if we want to have a separate infrastructure consultant or let Townsend do it, but we can decide that in the future.
Not to raise it, are there separate infrastructure consultants, and how many are there?
Let me get back. If we had a separate one, it would take us, we'd have to have a whole process, which is kind of why we bootstrapped it for short term, using Townsend. But I'll get back to a list and how big the population is, et cetera. The other thing that we've talked about in infrastructure, we'll talk to you guys about in the future is, so infrastructure is a real asset, and when you go through the presentation we're going to go through, a lot of it sounds like real estate. There's core and core plus and opportunistic. So one of the things that we're thinking of doing, and we'll work with Talon on, is changing our real estate into making it real assets. So it's broader than just real estate. But we can talk about that in the future as well. But let me see if we can start with this presentation. And again, the best way to do this presentation is for everyone to ask as many questions as possible, because if the team talks to you for half an hour, you won't get as much out of it as you could. That is Townsend here?
I'll keep it out.
See.
It's kind of the secrets.
Sorry. I don't know why we're going with it. I keep trying to tell them that. Nobody listens to me. Mostly bobblehead.
Good morning. Thank you for getting us. We are excited to...
More voice, yes.
More voice.
We're excited to be here and present to you the infrastructure as an asset class and why we believe it would be a good complement to the portfolio. What we are going to do today is that we're going to go through the characteristics of infrastructure, who the market players are, some definitions of infrastructure, to the investment thesis, again, why we believe infrastructure is a good complement to the portfolio, talk about the different strategies in infrastructure, and the benchmark and how we are thinking about it going forward. With that, if you can please open to page 3.
Sorry, can you reintroduce yourself again? I just want to make sure that-
Sure, absolutely. I'm Petya Nikolova, part of the infrastructure team. My background
At
BAM.
where do you work?
at BAM, Bureau of Asset Management, part of Larry's team. My background has been in infrastructure.
When did you join?
I joined 6 months ago. My last role was in project finance banking with West LB, a German bank, where I was doing direct deals in infrastructure. So we'll be a lender to projects. And I have been in different, have covered different sectors, utilities, transportation, and again, I have spent more than 12 years doing infrastructure. And my colleague Evan Nansen.
My name is Evan Nansen. I work with Petya for Larry. I just joined about 6 weeks ago. My background is also in infrastructure lending for the past 6 or 7 years for European banks here in New York.
And I'm Ishika Bansal. I am from the Thompson Group, which is also the real estate consultant for New York City. I work in the infrastructure advisory group.
Thanks again. So maybe we can start on page 3 with the definition of infrastructure. We have provided the definition for you, which is that infrastructure represents the fundamental facilities and systems serving a community. But most importantly, we would like to draw your attention to the characteristics of the infrastructure. The infrastructure provides essential services, water, gas, electricity, so fundamental services that we need for our everyday lives. Infrastructure assets have monopolistic characteristics. They often require very high capital costs. So if you have a project that requires $1 billion, this provides natural high barriers to entry and monopolistic position for the assets. These assets also have very long lives. They can vary between 20 years to over 100 years, so very long lives. And finally, they have stable and predictable cash flows because oftentimes they're under contracts or under concession agreements, so we have visibility as to what the cash flows would be, what the rates would be, or sometimes inflation protection would be. So we can see over a period of time what the cash flows would be. With that, I would turn to Evan to cover some of the sectors.
Thank you. One of the ways to characterize infrastructure assets is by the nature of the underlying asset, whether it's economic or social. Economic infrastructure is made up by services for which end users are willing to pay through fees, tolls, taxes, tariffs, or some other form. Transactions in this space can have a wide variety of structures and therefore can fall throughout the risk-return spectrum. Economic infrastructure composes the majority of the investment opportunity in the space. The other way to characterize an asset is as a social infrastructure asset. These are generally lower risk assets as end users aren't expected to pay for them. So the revenue for these investments comes from long-term leases or concessions with government entities. If you turn to the next slide, we'll see some examples of both. On page 5.
Could you, on page 5, what has been the return profile for, the economic infrastructure category versus the social infrastructure? Now, and, I know it's a general term, but I'm curious to see what the risk-return profiles offered?
Sure. So as I was saying, the economic infrastructure, if you look here on 5, composes a wide variety of different assets. And within each asset, there's different ways and structures for financing them. So this can really fall, as infrastructure in general, it's generally lower risk, but on the economic side, it can fall throughout that spectrum. Social infrastructure is on the lowest end of the spectrum, below almost anything on the economic side. These usually have defined cash flows, maybe they're inflation linked, and the off-takers are government entities, so they're credit-worthy off-takers in these cases.
Maybe just to point out, and we are going to discuss this on the next 2 slides, but another distinction would be whether or not the asset is under construction. Because if you have a social infrastructure asset, but it's under construction, the return will be higher because the risk will be higher.
Quick question here. Is the internet, the backbone of the internet, is that considered infrastructure?
I think going back to the fundamental characteristics and how we view it, because the definition can vary, we look for hard physical assets. So in the characteristics that we used, this would probably be an extended version, won't be necessarily core, that we have a real asset on the ground. But we would have, for example, for communications, some broadcasting towers that would fall into.
I mean, I pose the question, knowing how essential the infrastructure, the internet is to all our lives and businesses and the government, it just seems like that which is the sort of the skeleton of the infrastructure of the internet might well be considered infrastructure.
I think traditionally that hasn't been a place where you've seen infrastructure investors at this point putting money, whether it's because of the life of the assets themselves, whether they have to be renewed too often, the actual hardware, or just the technology is a little riskier than what we're looking for this type, when we put money in this space.
Another way to look at the infrastructure sectors is in terms of the life of the asset cycle. As we just mentioned, whether or not there is a construction involved. And we essentially have 2 categories. One is greenfield and one is brownfield. The greenfield assets have construction risk, development risk. They don't generate revenues during the construction phase. For the brownfield assets, we have assets with an operating history, so we can see how the performance has been of these assets. And they start generating revenues because they're already in operation from day one. Just 2 very quick examples for a greenfield project. Port of Miami Tunnel, for example, in Florida, around $1 billion project, 5-year construction period, 3rd-year concession, connects downtown Miami with the Port of Miami. The project is still under construction, expected to be completed on time. But essentially, for the first 5 years, it won't generate revenues, and it has the construction risk.
So is that an example of a public-private infrastructure project?
That's exactly public-private partnership program, yes.
Why is it called greenfield? You use it as an example of greenfield. It's a tunnel. I mean, you might have a tunnel somewhere else. There are a lot of old tunnels. Greenfield's kind of a new word. I'm just trying to grasp your terminology.
Because it's under construction, that's a terminology that
So
has
it's
been
green, in other words,
adopted.
it's new because it's under construction. That's the idea. Okay.
No, it's green because you take a green field out in XYZ place, and you're gonna put some big asset on top of it.
Or under it in this case.
It's not green as environmental.
That's not the old definition of green and
Well, that's what I mean.
brownfield. Brownfield is like Veldon on an oil site, or toxic.
Green is the easiest way to do it is think about it as green field is a new construction. A brownfield is you're buying an asset.
And another example, also very quickly, toll road in Puerto Rico, also around 1 billion, but toll road, it was a relatively recent transaction completed last year. To illustrate the brownfield nature of that, so this toll road has had a 40 years of operating history. Again, a 30-year concession agreement, but we're just buying an asset that has been in existence for 40 years, so we can see exactly how it has performed over cycles.
Can you go into the reason why there was this public-private infrastructure project in, which it was Miami, the tunnel? What was the thought process that, I don't know if it's the Port of Miami or the City of Miami or whatever the entity is, was it financial in that it was $1 billion project and Miami doesn't have, is budgetary constrained and therefore this is a way to do it, or is there some other rationale for it?
Sure. I would say there were two main reasons. One is the fact that attracting private capital had allowed Miami, the concession is under the Department of Transportation, but there are contributions by the City of Miami and County of Miami as well. So we have some public funds going into the project, but the majority is private funds. So this allowed them to invest in the project immediately. They didn't need to wait for years and years for the budget to be allocated and invested in. And another important consideration was that the project is extremely difficult technically. So by involving a private partner, they were able to transfer construction risk to the private party and execute on that. The contractor on this project is Bouygues. Bouygues, it's a big French conglomerate known for building tunnels. They have done tunnels in extremely difficult conditions, and this goes underwater. So it's a very complex technically project.
And so ultimately, they're going to charge, the revenue stream is what, and then and the details are how they're splitting up the revenue stream ultimately to pay back the private partner and whatever their costs as well as the return. And then the various municipal sectors get a revenue sharing. Is that over a certain period of time? Then who ultimately owns it? Or is there some sort of disposition at the end of this that would give, let's say, an investor like us, you know, our IRR over whatever period of time?
So this deal has been structured as an availability payment, which means that as long as the tunnel is open to traffic and operating are then under predetermined conditions under the concession agreement, the concessionaire gets the payment. So it's based on availability and standards of operation versus traffic. That's independent of traffic. And you see that because traffic cannot always sustain a project. So you can see this type of availability. Actually, it's pretty common structure.
So the availability, who pays the
Department of Transportation.
Oh, the Department of Transportation pays the availability.
Right. The concession.
And that's predetermined, the amount, or?
That's correct. So you look at the 30 years of the concession, everything is in a financial model, everything is in contracts, many of them, and it's very much described and prescribed.
But if, and I hate to get too deep in the woods here, but I'm just looking at the revenue source. If it's the federal DOT, and if there is a movement to reduce the budget deficit, and there's cuts into the Department of Transportation, isn't it possible that these funds could be cut as well?
So this is the state DOT we're talking in this particular case. You are right. I mean, is that potentially possible? Yes, but then you need to look at the due diligence. That's part of the due diligence that is being done. And the Department of Transportation, is it AAA or AA? AAA. So it has a AAA rating. And again, you look at a lot of variables and how they fit together to make an investment decision. AAA is a pretty strong rating. Another component of that is that in the US, they're very efficient capital markets. So if they default on a payment, they won't be able to execute anything else. And they have a strong pipeline of projects there. They have done some other deals. And also their municipal bonds. If you default, you default. So there are a few things that mitigate this risk.
I think we should just let them go through their presentation, which is quite long, and I think there's a lot of, this ground will no doubt be covered by what they have in mind here. Because if we go like 5 minutes per page, it's going to be a long presentation.
Going to page 7, just looking at how the deal flow looks like. And what you would see on the left-hand side are the infrastructure deals by project stage that are predominantly brownfield, both globally and the US. And the infrastructure deals by sector on the right-hand side. And what you notice is that the sectors are primarily energy, utilities, and transportation, again, globally and in the US. On the next 4 pages, we have prepared 4 case studies. We don't intend to go through them today. It's more for you to read when you have a chance. And with that, I'll turn over to Ishita.
On slide 12 now, there is both a demand and need for infrastructure investing. The infrastructure in place is more than 50 years old and needs to be replaced. Economic growth and population growth has also created a need to build new infrastructure, and budget deficits in the US and Europe have created a need to look for a new source of capital. As a percentage of GDP, infrastructure spending has continuously declined, and in the US, it is the lowest when compared to other developed countries. It is estimated that it could cost over $2 trillion to replace the existing infrastructure. It is also not just about replacing the existing infrastructure, it is also about creating new infrastructure. The US is expected to add 30 million people to its population every 10 years. And the world population is expected to increase from 7 billion to over 9 billion by 2050. Moving to slide 13, it shows a world map and infrastructure capital needs by region. In a recent research report, most infrastructure systems in the US were graded a D or worse. A combination of overuse and underinvestment has created a significant need to invest in infrastructure. It is estimated in Europe that it could cost over 2 trillion euros to invest in transport and energy. Moving to slide 14, the pie charts show where infrastructure capital was raised and where it was invested. North America and Europe are the largest markets for raising infrastructure capital as well as investing infrastructure capital. In terms of investment activity, the most investment activity historically has been seen in European markets. Moving to slide 15, yes.
So how would you describe the trend? Are there more, are there a growing number of new deals in North America, and is the field maturing in Europe and shifting over to the U.S., or is the U.S. shrinking? What are the trends in terms of the activity of infrastructure deals or investment opportunities?
Well, historically, and this data represents 5 or 6 years of data and goes up to 2011. So Europe has historically been the largest market, and there are so many different countries in Europe, and there are a lot of large assets, and also the environment in Europe has been traditionally very favorable to infrastructure investing. We'll see later in the pages that most of the investing in infrastructure in the U.S. has been more recent, to your point. So going forward, it is it could very well be the case that they shake out to be equal pies. But right now, I think we see more infrastructure deal flow in Europe just because of how it has been positioned historically.
So there's definitely expectation that the deal flow would likely increase in the U.S.?
The largest infrastructure sector in the U.S. is energy. There is a lot of infrastructure investments happening in the energy space. In the U.S., it's more airports and transportation assets. So there are different markets for transportation assets or ports and airports. You need to write larger checks and larger investments. For energy assets, you need less investments. So in terms of dollars invested, it could very well still be the case that Europe commands more infrastructure investments than the U.S. But in terms of number of infrastructure deals taking place, we could see more activity in the U.S. versus Europe.
Thank you.
Moving to slide 15, the structures for investing in infrastructure are still evolving. Public to private partnerships have been slower to evolve, but this is a growing area, and more deals will get completed that are mutually beneficial to the public sector and the private sector. In the current market environment, the energy sector presents the most actionable opportunities in infrastructure. The development of shale gas has created a significant need to build out natural gas transmission and storage. There's also a need to invest in renewables as more states are adopting renewable portfolio standards, and there's a shift from coal to natural gas. On slide 16 shows the...
Sorry, your last bullet on page 15? Availability of debt is less of a factor in suppressing transaction activity.
Thank you.
Well-structured projects can obtain financing. So how does that trend affect the potential potentially for our investments in infrastructure? If infrastructure projects are able to get financing more easily, is that good for us, bad for us, or a little of both?
Well, for investments that are structured well, financing is easily available. So where there is an attractive risk-adjusted return available, we will see debt available for those investments. For investments where there is a little bit more of a risk factor, debt and financing is going to be difficult to achieve, as it has been in the last 4 or 5 years. In terms of the availability of debt is good in terms of making an investment, because the deals are structured with debt and equity. So I think it is more advantageous than detrimental that debt is available for deals that are structured well.
Jimmy, let me see if I can be a little clearer. The funds that we're looking at are generally equity funds where we own the assets, as opposed to we're going to provide loans. The loans that are out there are really two types. One that banks make, bank loans, and the other is something below that, all of which our debt managers buy. So PIMCO, BlackRock, those kind of guys buy infrastructure loans. And one of the trends that's in the market today is a lot of the European banks were holders of infrastructure loans, and they're, as you know, European banks are under pressure, so they're making less loans and they're selling loans. So you're going to find that our debt side of the house, some of our debt managers are buying infrastructure loans. But this is sort of akin, or this presentation is sort of akin to private equity. Just private equity, instead of buying a business, you're buying an infrastructure asset, and a fund then is a collection of infrastructure assets. Okay?
So this trend is, has different effects on essentially different infrastructure investing strategies.
Yes. But again, we're viewing it as equity investments as opposed to debt investments. I mean, we might wheel around an infrastructure debt fund if some of the bad trends in lending continue. But again, right now, the infrastructure loans are getting bought by debt managers as it is, so there might not be a need for us just to have an infrastructure debt fund, but maybe, who knows? But again, view this as sort of akin to private equity or even more akin to real estate. Because what you're about to find is there's a lot of real estate words about to come. So again, we own buildings. Now this is like, instead of building, you're going to own a bridge. Any of those.
15 bucks a pop.
Go ahead.
On slide 16, there are two groups of investors investing in infrastructure. Some very large pension funds, sovereign wealth funds, and insurance companies represent the largest category of investors in infrastructure. The investable universe of infrastructure funds has grown very fast from where it was in 2004 and 2005. There is more segmentation to the market now. Investors can choose where to invest and how to invest. Infrastructure funds can be segmented by risk profile, geography, and sector.
Does this mean the New York State Common and New York State teachers are not infrastructure investors yet? Or this is just a representative list? Do we know if they are?
If you look at slide 18.
Slide
18.
Yeah. Okay.
So yes, the New York State Common has an allocation to infrastructure, which is represented by the fourth bar on the chart.
Okay, thanks.
So on slide 17, we can just see some of the names of some of the largest investors in infrastructure. Public pension funds has historically contributed, has been the largest investor in infrastructure. Slide 18 shows the infrastructure allocations of some of the investors in infrastructure. Australian, Canadian, and European investors have historically been, long-standing investors in infrastructure. Typically, for U.S. pension funds, we see an infrastructure allocation of between 2 and 3%. On slide 19, we talk a little bit about...
Can I stay on 17 for 1 second?
Sure.
Actually, it's 18. 18 is the page I'd like to talk about. So if you look at 18, or 17 and 18 together, the Australians and the Canadians have taken to infrastructure probably 10, 15 years ago, and they invest directly. So they have a team of 20 to 30 people inside their pension fund that seeks to buy the infrastructure asset directly. The alternative is what the Americans are doing, which is you invest in a fund, kind of like a private equity or a real estate fund. The beauty of investing direct, and we're just having a tutorial, let alone investing direct, is what the Canadians and the Australians think is, well, we have 30, 40-year liabilities, and if you own a contract for, say, the Pennsylvania Turnpike for 30 years, and the tolls are adjusted for inflation, you've just bought a perfectly inflation-hedged asset. So we're going to own the toll road for 30 years, you get a grant from the government for 30 years, you're going to get a rate of X, and we should have a bunch of that stuff. So again, if you look at their portfolios, they buy them and hold them for the 30 years. The mismatch that we're about to get ourselves into, which is what the American funds do, but they ultimately get into direct investing, is if you invest in a fund, like a real estate fund, you're buying an asset to resell the asset, right? So you're paying a lot of transaction fees. So you pay a management fee and then a 10 or 20% carried interest when you exit. And just like, should we buy this building? If you actually thought you were a long-term investor, you buy this building and own the building, as opposed to invest in a fund that buys the building, keeps it for 7 years, sells it to another fund that we invest in, and sells it to another fund that we invest in. That's why these numbers are so different between the U.S. funds and the Canadian and the Australian funds. But again, it goes to a much longer conversation that we have not today, not on this, which is staffing and how you should invest. Do you invest direct? Do you have to manage money in-house or out-house? But the Canadians and the Australians are really the biggest, most aggressive in this asset category.
And there's a third option, Larry, which has been presented us before, and that's co-investing with these guys.
That's the thing in the middle.
Yeah.
You still need to have a team that analyzes.
Right, but you don't need to have the same size of team that you would have if you were buying the asset outright.
That's right.
Now-
But to co-invest, you need to have a team that is
Yes,
knowledgeable, right? And
Exactly.
understands whether it's a good investment or a bad investment. So the progression, in fact, we're going to talk about this when we talk about the real estate plan, the progression is you invest in funds, then you co-invest, then you own the assets directly.
That's right.
That's just the way, and again, private equity is the same way, real estate's the same way, infrastructure's the same way. They're all kind of
And
investing the same.
there are U.S. public pension funds that are co-investing with Canadians.
Yeah,
Right, doing this third option, which,
but they've already
Produces,
started, they've already invested in funds. They're ahead of us.
Tricia had a question.
Yeah, Larry, I was looking at something on page 15 about failed or publicly scrutinized privatizations, and they used the Pennsylvania Turnpike as an example of one that created long-term uncertainty for the market. Was that just a moment in time and that's been corrected, or?
I'll let, you want to talk about Pennsylvania Turnpike?
Yeah, what was, I didn't hear the
Okay,
final part.
I would say, if you want to look at page 15,
Right.
under the public-private partnerships, there's a bullet that speaks to the failed or publicly scrutinized privatizations. For example, Pennsylvania Turnpike. And they also mention the Chicago Skyway, but they still create long-term uncertainty for the market, and I'd like to understand what that is.
Yeah. So the Pennsylvania Turnpike transaction was, I would say, right before the global financial crisis hit, that time period. And what happened there is that it was going to be an asset monetization of the Penn Turnpike. They ran a big process. A lot of groups responded. I think the winning bid was probably 8 to 10 billion, something really, really huge.
How big? I didn't hear what the number was.
8 to 10 billion probably. Very, very large numbers. And this would have been a traffic-based transaction, so not availability like the Port of Miami. The revenue stream would have been by tolls collected on the turnpike. What happened is that although a big process has been run and engaged a lot of investors, the deal was still subject to legislative approval, and it didn't pass. So this, it didn't pass through the legislation. So there was no ultimate approval for the deal going forward. What does this mean for the market is that you had at least 3 bidding groups spending millions and millions of dollars, because these are heavily, heavily due diligence deals, especially when it comes to a huge asset like that.
Am I to understand the deal fell apart?
Yes.
Oh, there isn't. Okay.
So it wasn't completed.
Got it. Thank you.
Which created this uncertainty and as to how these type of structures would be implemented. Yeah.
What a surprise the legislature didn't pass it.
Can you comment on some of the factors that they're not passing?
Maybe I'll rather come back to you on that, because this deal has been like probably 5-6 years ago.
Okay.
But
But
it's,
that was an outlier, really. Most of these public-private partnerships in the United States, where they're building infrastructure, that's not an issue because it's been approved by the legislature and the governor. Prior to that, these guys decided, the investors decided to go forward prior to that happening, and that was the risk they took, and they paid the price. So, I mean, typically you wouldn't want to get involved in deals where you had that kind of contingency laying out there. Am I correct?
right, although, to be fair, sometimes it's a matter of communication and expectation, and I guess you're right, it's a matter of choice whether or not you get involved when you have this contingency.
Sellers can change their mind, and the sellers in this case are political organizations, and they change their mind. Get stuck in politics. And the only thing that this was a big deal, people spent a lot of time on it, and then the seller decided not to do it, so people are just a little annoyed about that. But that's their business. Their business is sometimes you win, sometimes you lose, sometimes the seller doesn't decide to sell.
But I mean, talking about this subject there, this, I think, would be part of a larger discussion about some of the details of these transactions with respect to security, how the revenue streams work, that kind of thing, which I don't think we're getting in today. But,
Right.
I mean, I think our next session will talk about how our interest in these projects would be secure, what the risks are in terms of the revenue streams and that kind of thing.
So let's go forward. Are we on 19?
So why is an investment in infrastructure attractive? Infrastructure investments are attractive because of their ability to diversify a portfolio and provide an attractive risk-adjusted return. Many infrastructure assets have inflation-linked contractual cash flows that are less sensitive to changes in the economy. Infrastructure assets are also a great fit for the portfolios of long-term investors because of their long duration lives. All these characteristics result in an attractive return from an infrastructure investment. In the following pages, we validate the investment thesis for infrastructure. The table on slide 20 shows the correlation of infrastructure investments to public markets. And over time, infrastructure investments have shown to have a low correlation to the global markets. Even if we look at the publicly listed infrastructure index and adjust it for the financial crisis or go back longer in time, we see that it would have a lower correlation than what is shown on this table.
There's a higher correlation to real estate then?
I'm sorry?
What's the correlation to real estate?
The correlation of infrastructure to real estate is around 0.2. So the last row on the table shows the correlations of infrastructure. The infrastructure to global equities is 0.2. And then when we move down that row, the correlation of infrastructure to the NPI is 0.214.
But it's almost one to the S&P.
It's almost Are you looking at the Dow Jones Brookfield Global Infrastructure Index?
I guess I was looking at page 20, is that the one page?
Right, so if you look at the last row on the table, it is titled the Townsend Infrastructure Composite. So we are using our own customized infrastructure composite, which is the investments that Townsend's clients have made into infrastructure funds.
Oh, I see.
The Dow Jones Brookfield Index is a publicly listed infrastructure. It's going to show a much higher correlation to public markets.
How would you describe the composition of the investments in your composite? Are they like, most more like your usual normal private, real estate investments?
Yes.
As opposed to index funds or loan?
Right, these are private equity structures, and these are infrastructure equity funds. They could be an open-end structure or a closed-end structure, but they're valued quarterly versus being valued more frequently than the public markets. So they are very, very similar to the real estate investments that you would find in your portfolio. On slide 21, shows return data on infrastructure investments. Over longer periods of time, infrastructure has shown to produce an attractive risk-adjusted return. Again, using the data that we have available that Townsend has collected on its infrastructure investments, that we can see that over longer periods of time, infrastructure investments have shown to produce a return of 8%. On slide 22, the chart shows that the revenues of infrastructure companies have grown faster than the CPI or inflation. And this is because infrastructure assets, like we have talked before, provide a contracted inflation hedge and long-term stable cash flows that are inflation indexed. An example is toll roads, where tolls are adjusted annually for inflation. Revenue increases are typically embedded in the contract, and these contracts can run from 15 to 20 years in length. The chart on slide 23 shows that even in the most difficult financial times, the earnings of infrastructure companies have grown faster than global equities. In 2008 and 2009, infrastructure was shown to have more stable earnings than global equities that lost value. Petya will now talk about the different infrastructure strategies.
So we are on page 24 now. And we have three infrastructure strategies depending on the risk-return profile. The lowest risk strategy is the core strategy. The assets in this strategy are core, they are brownfield, they're mature assets, and they are typically in well-developed countries, OECD countries. Still on the lower side of the risk spectrum is the value-added strategy. In this strategy, we still have mature assets in OECD countries, but we can have an operational enhancement. So if we go back to the example with the road in Puerto Rico, as it currently stands, is a core asset, long operating history, and the new owner just continues to operate it. If a new extension is built to this road, this would be part of a value-added strategy. And then the last strategy, the highest risk strategy, is the opportunistic strategy. There we could invest in greenfield projects, we could invest in non-OECD countries, and if we continue with the toll road example, this would be a completely new toll road, greenfield toll road it's completely new build, maybe in an emerging market. This would be more of an opportunistic strategy. If we go to the next slide, 25, you would see these strategies represented graphically. So what you would notice is that certain assets tend to fall under certain strategies. For example, you would notice that the core strategy, we typically have in it mature social infrastructure or mature toll roads or transmissions and pipelines. On the other side of the risk spectrum, on the opportunistic PE-style type of strategies, we typically have telecommunications, greenfield toll roads. So certain assets, again, tend to fall under certain strategies. Having said that, if you turn to page 26, what you notice is quite a variation of returns for certain assets. If you look at the right side of this graph, power generation, you would see that the returns may vary from 12 to 25%, which is a huge difference. And the reason for that is that we can have an asset that sells its power under long-term contracts, where again we know what to expect, or we can have the same asset selling power into the market, where we don't know what the price would be, so we have a lot of uncertainty. We are highly dependent on the market cycle. So the point on this is that it really depends on how the structure works for the deal. We may have the same asset, but different structures.
And these returns are company level returns, or are they
Our company said?
level?
Level.
Company level returns, or they're fund returns?
Or there?
Company level. Gross of fees, company level, or asset level.
Okay. So we would get different returns from fund
Absolutely,
investment?
yeah.
That's a big, and just looking at the spreads, and you've talked about why, but they're very wide. And, so I think just understanding returns is going to be, the risk of return is going to need to spend a little time, and I don't know if we necessarily do it here, but I just am concerned with such a wide spread. You can drive a truck through these spreads, the bid-ask, if you will. And so I think there just needs to be develop a little more understanding about that.
Sure. Look at the next page, just to help the conversation a little. See your
Sorry,
point?
can I just raise one on the previous page? It's relevant. Well, comparing page 20 where you have the numbers for correlations and use the Townsend infrastructure composite, which you said was private equity investments, and then the volatility page on page 23 says it's an analysis of public companies. Is that sufficiently compatible, sort of comparing this bar graph of public company volatility with the